Dear students, today I'll tell you about shares as a source of finance. Do you know? Share is the important source of business finance of a company. Capital raised by issue of share is known as share capital. What do you mean by share? Actually, share is the small unit in which capital of a joint stock company is divided. Each share has its nominal value. For example, a company may have share capital of rupees 50 lakhs, which is divided into 5 lakh shares of rupees 10 each. Rupees 10 here is the nominal value, or you can say face value of share. Company issues shares to the public. Public purchases these shares. These persons who purchase shares of the company are known as shareholders. There are two types of the shares which can be issued by a company. One, preference shares, and second, equity shares. Now I will tell you about both of these types of the shares. First, preference shares. Capital obtained by issue of preference share is known as preference share capital. According to section 43 of the Companies Act, preference shares are those shares which enjoys two preferential rights over equity shares. One, regarding payment of dividend, and second, for repayment of the capital. Preference shareholders get dividend before any dividend declared for equity shareholders, and dividend payable to these shareholders is fixed. And regarding capital, they get refund of capital before repayment of the capital to the equity shareholders in the event of winding up of the company. Some of the important features of the preference shares are presented here. These shares are repaid after a specified period of time, and this period will not be more than 20 years from the date of issue. And I told you about payment of dividend to preference shareholders. Dividend to these shareholders is paid at fixed rate before the payment of dividend to equity shareholders. And it is not necessary to pay dividend in every condition. In case of loss to the company, it may be decided by the directors not to pay dividend in that year, as dividend is paid to these shareholders also, like equity shareholders, out of profits only. And another important feature here is for voting rights. Normally voting rights are not provided to these shareholders. They enjoy voting rights only in special circumstances. For example, if dividend is not paid to these shareholders consecutively for last 2 years or more, then voting rights may be provided to these shareholders. It can be observed from these features that preference shares have some characteristics of both equity shares and debentures. Like fixed rate of dividend is distributed to them, same as of fixed interest payable on debentures. And on the other hand, this dividend is paid out of profits only, in the same manner as dividend is paid to the equity shareholders. There are different types of the preference shares. This classification of preference share can be done with reference to the payment of dividend, participation in the surplus profit, and convertibility. In each of these categories, there are two types of the preference shares. First, on the basis of payment of the dividend. There are two types of the preference shares, cumulative and non-cumulative. If shareholders have right to get previous year unpaid dividend out of current year profit, they are called cumulative preference shareholders. For example, if dividend for 2019 was not paid due to non-availability of sufficient profit, this dividend can be paid with the dividend of current year to the cumulative preference shareholders. If this right of previous year's payment of dividend out of future profit is not provided to shareholders, these are known as non-cumulative preference shareholders. Second classification, on the basis of participation in the surplus profit. In this category also, there are two types of the preference shares, participating and non-participating. Participating preference shares are those shares which have a right to get additional dividend out of surplus profit of a company after dividend at certain rate has been paid to the equity shares. If such right of participation in the surplus profit is not provided to the preference shares, they are known as non-participating preference shares. Third classification on the basis of convertibility. Convertible and non-convertible preference shares. Convertible preference shares can be converted into equity shares within a specified period of time, whereas non-convertible preference shares can't be converted. Now, I'll tell you about merits of preference shares. Preference shareholders get regular income at fixed rate. An investment in the preference share is also safe, as they get the preferential rights of refund of capital in the event of winding up of the company. In this manner, investment in this type of share is useful for the investors interested in regular income with comparatively low risk. Further, control of the equity shareholders over the management of the company is also not affected, because preference shareholders don't have voting rights. Equity shareholders continue to manage the company through voting rights provided to them. And if company is earning very good profit, then after payment of dividend to preference shareholders at fixed rate, remaining profit may be distributed to the equity shareholders. In this way, company may declare higher rate of dividend to the equity shareholders. And one last point, there is no mortgage required to issue the preference shares. Means preference shares does not create any charge against the assets of the company. Means these assets are free of charge and can be used to take the loan on mortgage. So it is also one of the merits of the preference shares. Okay, now see other side of the coin. Means limitations of the preference shares. It is old saying, no risk, no gain. Some of the investors may be interested in taking risk for higher returns, but investment in preference shares is not suitable for these types of the investors. And sometimes equity shareholders get very less amount back out of their investment in the event of winding up of the company, because of preferential rights for refund of capital provided to preference shareholders. In this way, it dilutes the claims of the equity shareholders over the fund available. One more point here for limitation, rate of dividend. Rate of dividend on preference shares is generally high than the rate of interest payable to debenture holders, which make this source of finance costly as compared to the debentures. And dividend on these shares is paid out of profits only. If there is no profit, dividend may not be paid. Means there is no assured return on the amount invested by the investors. So you can say these shares may not attract large number of the investors. And from taxation point of view also, these shares are not beneficial, as dividend paid is not deductible item. It is not deducted before calculation of the income tax. So there is no tax saving in this case, whereas tax saving is possible in the case of interest on loans, because interest is deductible item for the purpose of calculation of income tax. Is it clear? Now I will tell you about second category of the shares, that is equity shares. Any share which is not preference in nature is called equity shares. Means equity shares don't enjoy preferential rights of payment of dividend and refund of capital. These types of the shares are known as ordinary shares. Fixed rate of dividend is not paid on these shares. Dividend payable on these shares depend upon profit available for the distribution. And these shareholders are the owners of the company. Some of the features of equity shares are listed here. I will tell you about all of these features. 1. This source of finance is suitable to arrange the funds for a long time period, as equity shares are not redeemable within the lifetime of the company. Equity shareholders are the owners of the joint stock company representative of these shareholders manage the company. That's why this type of capital is also known as ownership capital. Every joint stock company must have equity shares. It is one of the basic requirements for creation of a company. And I told you earlier, the dividend payable on this share is not fixed. It is fully depending upon availability of profit for distribution. And one more point, these shareholders participate in the management of the company through voting rights. These voting rights are available to equity shareholders in the proportion of shares held by them, not one person, one vote. Now merits. There are some merits of these types of the shares. One, these types of shares are purchased by those investors who are willing to take risk for higher returns. But on the other hand, dividend on these shares is not paid compulsorily. From company's point of view, it is one of the merits of the equity shares. Why? Why is it merit from company's point of view? Because there is no burden on the company. If there is no profit in a particular year or sufficient amount of profit is not available for distribution, then dividend to equity shareholders may not be paid. And one more point here, amount raised by issue of share is permanent capital of the company, as this is not repaid within the lifetime of a company. Further, this capital provides safety to the creditors also, because claim of the creditors is settled first, then capital is refunded in the event of winding up of the company. And mortgage, or you can say security of the assets in simple words, is not required for issue of shares. So there is no charge on the assets. Company's assets are free of any charge. The amount raised by issue of share is used to create the assets, and these assets can be mortgaged to take the loan. So you can say this capital provides creditworthiness to the company and confidence to the creditors or lenders. As you know, voting rights are available to these shareholders, so there is a democratic control of the company, as they participate in the management of the company through these voting rights. So these are the some of the important merits of the equity shares. With the merits, these shares also have some limitations. As I told you earlier, dividend on these shares based on profit available. Sometimes there is very good profit, sometimes less amount of profit is available for distribution of dividend. So dividend paid on these share is fluctuating. So investment in these types of the shares is not suitable for the investors who are interested in regular income with low risk. And there are a lot of formalities for issue of shares. And a large amount is spent to complete these formalities. So you can say cost of raising fund by issue of equity share is higher than the other sources. And for expansion of the business, if company raised more funds by issue of the additional equity shares, voting rights are provided to these new shareholders also, which may dilute the voting power and income of the existing shareholders. And last but not the least, there are possibilities of delay in the issue of shares. You know why? Due to lengthy procedure. As I told you, there are a lot of formalities, and procedure for issue of share is very lengthy, which consumes much time. Result? Delay in the issue of shares. Is it clear? So in this manner, you may understand the concept of shares. If you like this video, or you have any doubt or difficulty in understanding this topic, please mention in the comment box. Thanks for watching.